Misreading which costs really matter can turn a decision that looks profitable on paper into a real loss. In this video, we will sort costs into two piles, relevant and irrelevant, so you know exactly which figures to include in a decision and which to ignore in your exam and at work. In management accounting, a cost is relevant only if it is a cash flow that will happen in the future, because you choose a particular option. If the cash movement would be exactly the same, no matter what you decide, it does not help you choose and you treat it as irrelevant. Think of relevant costs like this. You are choosing whether to take a taxi or a bus, and you only compare the future cash you will pay for each ride. The money you spent on transport last week is interesting history, but it does not change what you should do now. That leads to a key rule. Any cost from the past or any amount already committed that you cannot avoid is irrelevant for a current choice. These are called sunk or committed costs, and no decision you take today can change that they have already been incurred. For example, if a company has already spent $250,000 on developing a service, that $250,000 is a sunk development cost. Whether you now launch the service or cancel it, the $250,000 has been spent and must not be included in comparing the options. Relevant costs must also be real cash movements, not just accounting entries. Non-cash items like depreciation or an overhead share that is simply spread across products are ignored, unless they would actually change in cash terms if you choose one option over another. Another key feature is that relevant costs are incremental. That means they are the extra cash in or out that arises under one course of action, compared with another course of action you could take instead. Imagine you have an employee who is currently idle, but still earns a basic wage of $100 per week. If you give them a small job that brings in $40 of revenue, the $100 is not incremental because you pay it whether they work or not, but the extra $40 revenue is incremental and therefore relevant. Relevant costs are often described as avoidable costs. An avoidable cost would disappear if you stop a specific activity, while an unavoidable cost will continue even if you shut that activity down. So unavoidable costs cannot be saved by that decision and are not relevant. When you choose between options, what really guides the decision is the differential cost or differential benefit. This is simply the difference in total cost or total profit between the alternatives, and it is that difference you should base your decision on, not the absolute size of each profit on its own. For instance, if option A costs $300 and option B costs $360, the differential cost of choosing B instead of A is $60. That $60 is the relevant extra outflow you are really deciding whether to incur for whatever extra benefit B gives you. Another crucial idea is opportunity cost, the value of the benefit you give up when you choose one option over the next best alternative. This foregone benefit is itself a relevant cost because by picking one path, you effectively sacrifice what the other path would have earned you. In practice, we also talk about controllable costs, which are costs a particular manager can influence within a set time period. Many fixed costs that are committed, like a long-term lease, cannot be changed in the short term, while some discretionary fixed costs, like a training budget, can be adjusted more quickly and might be controllable. Let us pull these ideas together with a worked example where you must choose between three mutually exclusive options A, B, and C. Their expected profits are $80 for A, $100 for A, $100 for B, and $70 for C, and you can only pick one of them. If you stare only at the absolute profits, option B looks best because $100 is the biggest number. But from a relevant cost view, you focus on the differential benefit and the opportunity cost. If you choose B, the best alternative you give up is A with a profit of $80. So that $80 is the opportunity cost of choosing B. The differential benefit of selecting B instead of A is the $100 profit from B minus the $80 opportunity cost from A, which is $20 of extra benefit. So the decision to choose B is justified not because $100 looks large on its own, but because it is $20 better than the next best option once you recognize the opportunity cost. So your takeaway is this: for every decision in the exam, strip out sunk, unavoidable, and non-cash items, then compare only the future, incremental, and opportunity costs and benefits between options. If you want more short lessons like this on management accounting topics, hit subscribe so you are ready for exam day.